Every market crash leaves behind two kinds of investors. Those who look back with regret, replaying the moment they sold in fear, wishing they had held on. And those who feel a quiet sense of calm, knowing they acted with reason, not emotion. The difference between the two isn't luck, it's philosophy. Benjamin Graham, the father of value investing, built an approach that not only protects wealth, but protects peace of mind. While others saw markets as a battlefield, Graham saw them as a test of temperament. He understood that most investors don't lose to the market, they lose to themselves. In this video, we'll explore why Graham's principles, from the margin of safety to his parable of Mr. Market, help investors not only survive market crashes, but emerge from them without regret. You'll learn how Graham's logic transforms panic into patience, fear into foresight, and uncertainty into opportunity. Because when markets fall, the greatest pain isn't financial, it's psychological. And the surest defense against regret is rational discipline. By the end of this lesson, you'll see how Graham's timeless philosophy offers something no modern investing trend can match: the ability to stay calm when everyone else is losing control. Picture two investors in March 2020. The world is shutting down. Markets are collapsing. Every headline screams uncertainty. The first investor watches his portfolio tumble day after day. He can't sleep. Every tick downward feels personal, a judgment on his decisions. Finally, in exhaustion and fear, he sells everything. He tells himself he'll buy back when things feel safer. The second investor feels the same fear, but he pauses. He opens his investment notes, revisits his valuations, and reminds himself of a principle he learned long ago. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. That line, written by Benjamin Graham nearly a century ago, helps him stay still. He doesn't sell. In fact, when prices fall far below intrinsic value, he quietly adds to his positions. Months later, as markets recover, the first investor realizes he sold near the bottom, his loss now permanent. The second investor, guided by patience and principle, sees his holdings rise again. The difference between them isn't intelligence or access to information, it's temperament. Graham knew this difference well because he lived it. In the crash of 1929, he lost nearly 2/3 of his fortune. But instead of despair, he chose discipline. He asked himself a deeper question. How can an investor build a method of thinking that prevents emotional ruin, not just financial loss? Out of that question came the foundation of value investing, not merely as a financial framework, but as a system for mastering the psychology of regret. Nearly a century later, the answer remains the same. When emotion becomes the market's loudest voice, reason becomes the investor's greatest refuge. Regret in investing doesn't come from loss. It comes from unpreparedness. It's not the fall in prices that hurts most, but the realization that we acted without a framework, that fear, not logic, made the decision. Benjamin Graham understood this truth deeply. He taught that the stock market's movements should never dictate your emotions, only your opportunities. In his words, the investor's chief problem, and even his worst enemy, is likely to be himself. Graham saw that markets will always oscillate between euphoria and despair. The investor's task is not to predict when those moods will swing, but to prepare for them before they arrive, because once panic begins, it's too late to build discipline.
That preparation starts with a clear distinction between price and value. Price is what you pay. It moves with emotion. Value is what you get. It moves with fundamentals. When you know the difference, a market crash becomes not a threat, but a test. This is why Graham's principles are so powerful in moments of crisis. They shift the focus from emotion to analysis, from reaction to reflection. They remind you that investing isn't about being right, it's about being reasonable. Graham taught that if your investment decisions are sound, temporary declines cannot harm you. They only become dangerous when you respond emotionally to them. That's why he insisted on something most investors still ignore. Every investment plan must be built to withstand both market loss and psychological pressure. In short, Graham's philosophy wasn't designed to make investors rich quickly. It was designed to keep them rational permanently. And that's what makes regret avoidable. Because regret doesn't arise from the market's actions. It arises from our own inconsistency with our principles. Benjamin Graham never relied on willpower to stay calm. He relied on structure. He knew that no investor, no matter how experienced, can think clearly when fear takes hold. So instead of trusting emotion, he designed systems that made rational behavior automatic. The first of these systems was the concept of the margin of safety, the idea that every investment should be made with a built-in cushion against error, uncertainty, and volatility. When you buy well below a company's intrinsic value, you create psychological space. You can think clearly because you've already prepared for imperfection. As Graham wrote, the essence of investment management is the management of risks, not the management of returns. The second was the separation between the defensive and enterprising investor. A defensive investor builds a portfolio designed to protect against mistakes, broad diversification, high-quality securities, and minimal emotional involvement. An enterprising investor seeks higher returns, but still operates within the boundaries of discipline and research. The key distinction is not aggression, it's control. Even the enterprising investor, Graham warned, must act consistently in a rational manner. Then there was his most enduring metaphor, Mr. Market. Graham imagined the stock market as a moody business partner, showing up every day offering to buy or sell your shares at different prices. Sometimes euphoric, sometimes depressed, but always emotional. Your job, Graham said, was not to argue with him, but to take advantage of him. If he offers you an absurdly high price, sell. If he offers a foolishly low one, buy. And if neither, simply ignore him. It was a framework not for timing the market, but for taming it. Together, these ideas formed a kind of emotional armor, a logical structure that protected investors not from loss, but from self-destruction. Because Graham knew that when panic strikes, intellect alone is not enough. Only a clear, predefined method can preserve reason when reason is hardest to find. And this is what most investors today are missing. They prepare portfolios, but not philosophies. They chase performance, but neglect temperament. Graham's genius was not only in what he taught about value, but in what he understood about human nature. Nearly a century after The Intelligent Investor was written, the market looks unrecognizable, at least on the surface. We have algorithms trading in milliseconds, 24-hour financial media amplifying every tick, and investors checking their portfolios more often than their heart rates. And yet, the emotional cycle is exactly the same. Fear and greed still alternate in perfect rhythm. The names have changed: dot-coms, subprime, crypto, meme stocks, but the psychology remains eternal. Each generation believes it's smarter than the last until the market humbles it in the same way.
In this hyper-connected age, regret has become faster. You can now watch your portfolio collapse in real time, your fear validated by headlines and social feeds. It's not just financial loss anymore. It's social proof of failure. That's why Graham's principles matter now more than ever. They reintroduce stillness in a world addicted to motion. Think about the investor who panicked in March 2020, or the one who rushed into speculative tech in 2021. Their choices weren't driven by data. They were driven by emotion disguised as information. Graham's discipline could have shielded them both. A margin of safety would have limited exposure. A clear valuation process would have revealed when enthusiasm exceeded logic. And the Mr. Market framework would have reminded them that volatility is an opportunity, not an insult. Even institutional investors, who pride themselves on sophistication, are not immune. Private equity managers, hedge funds, and pension allocators all fall prey to short-termism, a psychological contagion that Graham diagnosed decades ago. He would likely look at today's world of constant feedback loops and say, the data has changed, but the danger has not. The truth is, Graham's wisdom doesn't compete with technology, it completes it. Algorithms can analyze millions of data points, but they can't interpret value. AI can recognize patterns, but not principles. Only the disciplined human mind, grounded in Graham's logic, can distinguish price action from actual worth. In today's market, rationality is the rarest form of edge. And that's precisely why Graham's philosophy, calm, methodical, and principle-driven, remains timeless. Benjamin Graham's teachings reach far beyond balance sheets and income statements. At their core, they are a philosophy of human conduct, a guide to how we think, feel, and act under uncertainty. He saw investing as a mirror of character. Markets, he said, are not testing your intelligence, they're testing your temperament. Your ability to stay rational while everyone else is emotional determines not only your results, but your peace of mind. In The Intelligent Investor, Graham wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." That single line captures the entire psychology of markets. Because the real challenge isn't identifying undervalued companies, it's resisting overvalued emotions. It's staying skeptical when the crowd is euphoric and staying patient when the crowd is terrified. True investing, in Graham's view, was an exercise in intellectual humility. It meant accepting that you could be wrong, preparing for imperfection, and refusing to anchor your self-worth to market approval. The intelligent investor wasn't one who knew everything, but one who knew himself. And this humility gave rise to his second great virtue, discipline. Discipline isn't rigidity, it's clarity of purpose. It's what allows you to say no when greed tempts you to chase and wait when fear begs you to sell. It's what transforms theory into conviction. That's why Graham's framework feels almost moral. He wasn't just describing an investing system. He was describing a way to live, a way to think independently, to act with reason, and to anchor decisions in evidence rather than emotion. In that sense, his philosophy isn't just financial, it's ethical. To be a value investor, in Graham's original sense, is to commit to truth over trends, to measure wealth not by the speed of gain, but by the soundness of thought behind it. In a world where attention has become currency and speculation a sport, Graham's approach feels almost rebellious, a quiet act of defiance against noise, haste, and imitation.
He would remind us that true wealth is not built in the markets, but in the mindset that navigates them. When markets crash, most investors search for answers outside themselves, in headlines, forecasts, or talking heads. But Graham would remind us, the answers are not out there. They're within your framework, your patience, and your discipline. To apply Graham's wisdom during a crash, remember 3 timeless principles. First, separate price from value. A falling price is not always a falling business. The market can cut a stock's price in half without changing a single figure in its balance sheet. When others see a collapse, a Graham disciple sees a calculation. Second, demand a margin of safety. You can't predict the future, but you can prepare for it. By never paying full price for uncertain value, you give yourself room to be human, to err, to wait, to survive. The margin of safety is not just a number, it's emotional armor. Third, master your temperament. In panic, information loses meaning. The investor who can stay calm long enough to think, not react, gains a permanent edge over those driven by fear. Patience, in that moment, becomes performance. These principles are simple to understand, but difficult to live by, especially when the screen bleeds red and every instinct screams to act. And yet, it's precisely then that Graham's philosophy reveals its quiet brilliance. Because when you invest with a rational framework, the world can't shake your foundation, only your feelings. And feelings pass. In the end, Benjamin Graham did not promise wealth. He promised wisdom, the kind that outlasts both bull markets and bear markets, the kind that leaves you calm when others are panicked and steady when others are desperate. That's the real reward of Graham's approach. Not just better returns, but fewer regrets. Not just financial security, but emotional stability. Because when you invest with reason, you don't just protect your capital, you protect your peace. Nearly a century later, his message still echoes. Markets will always move between euphoria and despair. But the intelligent investor, the truly intelligent one, stands apart, anchored not in prices, but in principles. And that is why Benjamin Graham's wisdom remains timeless. Not because it predicts the future, but because it protects you from yourself. Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.